Sky-high tariffs were supposed to slam the brakes on the US economy. Prices are up, growth down, maybe even a recession, but that didn't happen. So, what actually went right, what's being delayed, and why are economists now rethinking everything they thought they knew? Chapter 1. The Tariff Shock That Changed Expectations. When President Donald Trump returned to office, trade policy shifted fast and aggressively. Within months, the United States imposed a new wave of import tariffs that dramatically raised the cost of foreign goods. According to economists at the Brookings Institution, the average tariff rate briefly surged to around 28% in April, compared with roughly 2.4% on Election Day. Even after negotiations and exemptions reduced the impact, the effective rate remained near 17%, still far above historical norms. For context, the US economy had not operated under tariff levels this high in decades. Financial markets, businesses, and economists all braced for disruption. The dominant assumption was simple: higher tariffs would raise prices, reduce consumer spending, slow business investment, and ultimately drag down economic growth. Some forecasts predicted stagnation, others warned of recession. This wasn't a fringe view, it was mainstream economic thinking based on past trade shocks. Which is exactly why what happened next surprised almost everyone watching closely. Chapter 2. Why economists expected the economy to falter. Before the tariffs took effect, most economic models pointed in the same direction. Tariffs function like a tax on imports, and taxes usually reduce economic activity. Higher prices were expected to hit consumers first, especially on everyday goods. Businesses that rely on global supply chains were expected to face higher costs, lower margins, and difficult decisions about layoffs or price hikes. Ben Harris, director of economic studies at Brookings, later explained that if economists had been shown the tariff numbers in advance, nearly all would have predicted a weak economy by now. Some would have expected flat growth. Others would have expected something much worse. The logic seemed airtight. Trade wars have historically slowed growth. Inflation had already been a concern, and the scale of the tariff increase was unprecedented in the modern US economy. So, when the economy didn't buckle under that pressure, it forced economists to ask an uncomfortable question. What did we miss? Chapter 3. What the economic data actually shows. Instead of stalling, the US economy kept moving. Gross domestic product expanded strongly through 2025, with third quarter growth reaching its fastest pace since 2023. Employment remained relatively stable, and consumer spending stayed resilient, even as public confidence surveys painted a more pessimistic picture. Inflation is still above the Federal Reserve's 2% target, but it is far below the highs reached in 2022. Prices did not surge immediately after tariffs were imposed, and broad-based economic indicators did not flash recession warnings. For many households, daily life felt more expensive, but not dramatically destabilized. This disconnect between expectations and reality puzzled analysts. Tariffs were real, trade costs were higher, yet the economy absorbed the shock without collapsing. That doesn't mean tariffs had no impact. It means other forces were strong enough to offset them, at least for now. And understanding those forces is key to understanding why the slowdown never arrived. Chapter 4. How negotiations softened the tariff blow. One major reason the impact was smaller than expected lies in what happened after the tariffs were announced. Initial headline rates made the biggest impression, but the outcome looked different. Negotiations led to exemptions, delayed implementation, and agreements that required trading partners to purchase US goods. As a result, the effective tariff burden turned out to be lower than early estimates suggested. Economists note that markets often react to announced policies, while real-world outcomes depend on how those policies are enforced and adjusted. Some industries received carve-outs, others found ways to restructure contracts. In many cases, the sharpest edges of the tariffs were smoothed through political and commercial compromise. This doesn't mean tariffs were harmless. It means their actual footprint across the economy was narrower than originally feared. And that gap between announcement and execution played a crucial role in delaying broader economic fallout. Chapter 5. AI. Investment and government spending step in. While trade costs were rising, other parts of the economy were accelerating. One of the biggest drivers has been a massive investment in artificial intelligence. Companies poured money into data centers, chips, software, and infrastructure, creating a powerful source of economic momentum. At the same time, government deficit spending and tax cuts continued to inject demand into the economy. These policies supported hiring, business investment, and consumer activity, even as trade uncertainty increased. Together, AI spending and government outlays acted as a counterweight to tariff pressure. Instead of slowing, large segments of the economy expanded. Productivity gains and capital investment helped absorb higher input costs without immediately passing them to consumers. This combination helps explain why traditional models fell short. They assumed tariffs would dominate the economic picture. Instead, they collided with an economy being lifted by forces few models fully accounted for. Chapter 6. How companies delayed the pain. Businesses didn't sit still when tariffs arrived. Many took active steps to reduce exposure and protect margins. Some companies stockpiled inventory before new tariffs took effect, locking in lower costs early. Others shifted parts of their supply chains toward countries not covered by the new rules, reducing immediate tariff liability. In many cases, firms absorbed higher costs instead of raising prices, choosing smaller margins rather than risking lost customers. Former trade advisors say these moves were deliberate. Companies prioritized stability, market share, and long-term positioning over short-term profit. Passing higher costs directly to consumers was often treated as a last resort, especially in competitive markets. Foreign exporters also adjusted. Some lowered prices to preserve access to the U.S. market, effectively sharing part of the tariff burden with importers. Together, these strategies delayed visible price increases for consumers. But delay is not eliminated. Stockpiles shrink, margins compress, and flexibility fades. Economists warn these buffers weaken over time, allowing tariff costs to surface gradually across industries nationwide today and beyond this year. Chapter 7. Why trade alone couldn't sink the economy. Another lesson from this episode is scale. Even with sharply higher tariffs, total tariff revenue rose by less than $200 billion. That number sounds large on its own, but it is small relative to a nearly $30 trillion U.S. economy. The United States is highly diversified. Domestic consumption, services, technology, healthcare, and government spending all contribute far more to overall growth than foreign trade alone. This diversity creates resilience, allowing weakness in one area to be absorbed by strength elsewhere. Ben Harris of the Brookings Institution argues that economists may have overestimated how much trade policy alone can disrupt short-term economic performance. Tariffs do hurt consumers and businesses by raising prices, but they rarely trigger an immediate collapse in an economy this large and complex. Their effects are often slower and unevenly distributed, harder to detect in headline economic data, and temporarily masked by strong domestic demand, innovation, investment, and fiscal support. Households, firms, and markets may not feel the impact right away. Chapter 8. Why not yet is the most important phrase. The most important words in this story are not yet. Economists caution that the forces protecting the economy may be weakening. Companies cannot absorb higher costs indefinitely. Stockpiles eventually run out, margins shrink, and shifting supply chains becomes increasingly difficult over time. Data already shows higher prices for imported goods affected by tariffs. Domestically produced alternatives are also becoming more expensive as reduced competition allows prices to rise. According to economists at the Brookings Institution, inflationary pressure linked to tariffs is real, measurable, and persistent. Wendy Edelberg has warned that inflation may remain elevated through 2026 and into 2027 as delayed costs finally reach consumers. Rather than a sudden shock, the impact may spread gradually across industries. The past year has tested economic assumptions and revealed the limits of forecasting. The U.S. economy proved resilient, but resilience is not immunity. The true cost of tariffs may simply be arriving later than many expected. So, here's the real question for you. Have tariffs been misunderstood? Or has the US economy just been unusually good at delaying the consequences? Do you think the worst effects are still ahead? Or do you think the economy has already absorbed the shock? Comment below. If this video helped you understand what's actually happening, hit like, subscribe, and see you in the next one.